Over the past week or so, an unsettling undercurrent has been quietly surging in the depths of the silver market. It announces its presence not through jaw-dropping headlines or instantaneous spikes and crashes, but in a more covert yet corrosive manner. The rift between electronic screen quotes and the physical delivery world's actual conditions is silently widening. Initially, this disconnect was negligible, easily overlooked. After all, in the cacophonous financial markets, the vast majority of minor price fluctuations are merely noise. But this time is fundamentally different because this anomaly isn't isolated to a single exchange, or region rather, like a systemic signal. It simultaneously flickers across inventory data, delivery behavior, and regional premiums. All indicators point toward a common endgame. To understand the severity behind this phenomenon, we must return to the foundational logic of global commodity markets. In a well-functioning system, the standard law of one price should be ironclad, metals of identical specifications and standards. Deliverable at major international hubs should not maintain significant price differentials over the long term. Once price gaps emerge, sharp-nosed arbitrageurs should swoop in like vultures, buying low, selling high, swiftly erasing discrepancies through risk. Free arbitrage. This isn't merely textbook economic theory. It is the physical mechanism maintaining global market integration. Once this mechanism fails, prices cease being universal global signals and degenerate into localized regional biases. What is most alarming in recent trading sessions is precisely that this self-correcting mechanism appears to be malfunctioning. Public exchange data and settlement prices reveal this once tightly knit global price network is loosening. Silver quotes across different major trading venues are showing substantive fractures. These disparities are no longer measured in trivial cent units, but have expanded to dollars per ounce levels. For a market as massive and liquid as silver, this phenomenon is not merely abnormal, it is disturbing. While this doesn't necessarily portend market collapse, it loudly questions, why isn't anyone filling this lucrative gap? If price differentials exist as chasms, why do they remain unbridged? We can enumerate conventional reasons: transaction friction costs, logistics bottlenecks, surging insurance expenses, tightened financing, or regulatory barriers. All might temporarily impede arbitrage. Even certain regions' high premiums might merely reflect local tax policies or specific product form scarcities. These explanations might hold under normal circumstances. However, when such spreads stubbornly persist against a backdrop of sustained high trading volumes, accompanied by violent fluctuations in physical delivery behavior, the situation's nature transforms. This complexity first manifests upstream in the supply chain, among institutions responsible for converting raw silver into finished products. When national mints or major refineries suddenly announce order suspensions or shipment restrictions, their stated reasons often seem mundane: raw plate shortages, production scheduling conflicts, or routine equipment maintenance. These reasons may not be lies, but when such technical pauses occur at demand explosion junctures, markets inevitably interpret this as acquiring adequate raw metal at current screen prices in spot markets is becoming increasingly difficult. This doesn't mean unavailable, but it signifies sand-like friction appearing between supply chain gears. Another more intuitive signal comes from exchange vaults. Monitored inventory levels fluctuate daily, large withdrawals themselves aren't unusual, financing turnovers, leasing operations, or industrial manufacturing all require metal transfers. But what truly warrants vigilance is the acceleration and concentration of inventory outflows. When withdrawal orders erupt densely within extremely short time windows, this typically signals fundamental mindset reversals among market participants, rather than holding convenient paper contracts. They now more urgently want to grasp weighty metal in their hands. This shift from trusting certificates to trusting physical often requires no specific black swan event to detonate. It is more a qualitative change from long-accumulated risk aversion sentiment. Futures market delivery data further corroborates this. Futures were originally designed as financial instruments for price discovery and risk hedging, not channels for large-scale physical procurement. The vast majority of contracts typically close or roll before expiration. However, when the proportion choosing physical delivery abnormally spikes, this releases a clear signal. Some capital no longer satisfies with cash settlement spread profits. They want actual silver. While this doesn't mean exchanges will default, if this trend solidifies, market assumptions about how much metal is available require thorough reassessment. Of course, relying on any single isolated evidence above is insufficient to assert systemic risk arrival. Markets possess astonishing self-healing capacity. Many anomalies often prove ephemeral. However, when regional price tiers, physical premiums soar, delivery demand surges, and inventory levels decline, when these four phenomena simultaneously resonate, we have reason to deeply investigate the driving forces behind all this. Industrial demand rigidity is a frequently cited key factor. Unlike investment demand that can exit anytime, industrial demand is tightly bound by massive production plans. Silver's irreplaceability in electronic components, photovoltaic panels, and high-end manufacturing means these buyers are extremely price insensitive. They cannot halt production because silver prices rose. If silver comprises a small total cost percentage, supply disruption risk far outweighs price increase fears. Driven by this psychology, industrial giants abandon the just-in-time low inventory model revered over the past decade, embracing just-in-case stockpiling strategies instead. This transition requires no panic emotion rendering, only uncertainties seed. Even if each enterprise only moderately increases safety stock, aggregating to the macro level suffices to instantly drain market liquid chips. Yet the supply side remains powerless against this. The vast majority of global silver doesn't come from independent silver mines, but as byproducts of copper, lead, and zinc mining. The special production structure determines silver supply lacks elasticity. You cannot rapidly boost copper mine output merely because silver prices rise. Though recycling markets provide supplementation, their response exhibits obvious lag, therefore short-term supply. Demand mismatches can only forcibly balance through price surges and violent inventory consumption. Additionally, we cannot ignore silver-gold linkage effects. Gold, as the global monetary system's canary, often reflects market-deep anxieties about currency credibility, interest rate prospects, or geopolitical risks through violent price fluctuations. Silver has historically played the high volatility gold role, though rarely leading rallies. It often follows with more exaggerated amplitudes. Gold's recent hovering near historic highs indicates safe haven capital is flooding in. This magnitude of market action typically accompanies investors repricing inflation spiral, fiscal deficit, or war risk concerns. Silver's synchronized strengthening isn't surprising. What is surprising is its physical market's divergence from paper prices. At this point, the gold-silver ratio becomes an important reference. This ratio's contraction often hints silver is undergoing value reassessment relative to gold. Behind this might be industrial demand recovery or speculative capital bets. While ratio analysis cannot predict futures, it can provide coordinates for current chaos. We must acknowledge counterarguments remain forceful. Regional spreads might naturally recede with logistics recovery. High premiums might fall as mint capacity increases. Delivery surges might be seasonal. History countless times proves excessive market stress interpretation often gets slapped. Markets always absorb shocks and rebalance in invisible ways. However, what is special about the current moment is variable resonance breadth. When mechanisms originally responsible for smoothing prices, like arbitrage, inventory releases appear sluggish, this hints market participants are recalculating risk weights. This reassessment might stem from macroeconomic gloom or fears of future long-term supply-demand gaps. Most dangerously, this perception and behavior form positive feedback loops. The more buyers worry about unavailability. The faster they rush purchases, the more holders worry paper gold is unreliable. The more they lock physical. These individually rational choices ultimately converge into collectively irrational exuberance, further intensifying market tightening. This process requires no specific starting gun. It is accumulated microdecisions. As situations evolve, core contradictions will ultimately return to that ultimate question: who controls pricing power? Screen futures prices matter because they're the benchmark for all contracts, accounting, and risk models. Physical transaction prices matter because they determine whether mines operate, whether warehouses restock. When these two price systems begin decoupling, even just gentle drifting, market participants are forced to choose sides. For industrial users, the answer is simple. The price where goods are available is the real price. But for financial institutions, this involves liquidity, hedging costs, and compliance red lines. Calculations are extremely complex. Current data indicates this game is an intense dynamic adjustment. Blood vessels connecting regional markets haven't completely severed, but due to poor circulation, blood pressure is rising. Whether this resistance dissolves over time or further deteriorates into thrombosis depends on inventory consumption speed and high prices demand suppression effects. What we can confirm is that the current situation is conducting an extreme stress test on market assumptions maintained for years. It interrogates how much spot is truly liquid, how fast do they move given logistics and trust barriers. When multiple demands overlap, can pricing mechanisms still sensitively respond? These questions won't yield answers in one trading day. They'll peel like onions, gradually revealing truth with each new data release. Markets are digesting tightening reality, reallocating risk in every contract, every shipping schedule. As this game deepens, we'll see which pressures are temporary bubbles, which are structural faults. One most visible indicator is the cost of immediacy. when spot or near-month contract prices far exceed forward contracts. Spot premium backwardation. This shows time itself has become expensive. In normal markets, futures prices typically exceed spot to reflect carrying costs, storage, interest. Current inverted structures indicate market desire for immediate possession of metal has overwhelmed holding costs. If this phenomenon persists, it shows buyers capable of taking delivery are extremely averse to future uncertainty. They'd rather pay high premiums now than wait. This market structure distortion also profoundly affects traditional intermediaries, bullion banks, refineries, and major dealers' survival rules. These institutions typically rely on balancing physical inventory and paper positions to earn stable returns, premised on smooth logistics and effective hedging. When physical demand becomes unpredictable, or counterparties firmly demand physical delivery rather than cash settlement, their balancing act fails. To this, intermediaries' response may not be collapse but contraction, reducing, quote, volumes, widening bid-ask spreads, tightening risk limits. This causes liquidity drought. Even if screen trading volumes appear massive, market makers truly willing to accept large orders at narrow spreads are decreasing. For end users, this manifests as unavailable goods. Scarcity feelings, even though global total output hasn't substantially declined. Regulatory and logistics barriers further intensify this fragmentation. Silver's cross-border flow is constrained by export controls, tariff barriers, and cumbersome customs procedures. When one region's demand surges, another surplus supply cannot instantly reinforce. This friction makes local prices more independent, weakening unified global market pricing authority. The result isn't complete market fragmentation, but drastically reduced coupling between plates. Financing costs are another often overlooked variable. In low-rate eras, funding costs for hoarding physical metal were nearly negligible. But in credit-tightening environments, holding physical not only ties up capital, but bears high opportunity costs. Those still willing to stockpile now are either rigid demanders or diehards believing paper asset risks will soon explode. This causes chips to further concentrate among these strong hands, market floating chips increasingly depleted. Additionally, silver's dual attributes, both industrial raw material and monetary metal, attract vastly different motivations. Some hedge inflation, others bet on photovoltaic industry explosions. In uncertain periods, these two narratives overlap, making price signals abnormally chaotic. Major institutions rely on long-term models and macro data, while retail and semis are more sensitive to immediate retail shortages and price surges. When these two forces align despite different reasons, market momentum forms. Analysts' biggest headache is distinguishing whether this rise is fundamentally driven or Soros's reflexivity's bubble. In this regard, gold remains the best reference. Gold markets are deeper, more centralized, with central banks as dealers. When gold continuously rises, it typically represents fundamental macro-level shifts, silver following gold, though more volatile. This linkage rules out silver single market manipulation possibilities. Of course, this doesn't preclude overshooting, but it provides macro anchors for analysis. Gold-silver ratio's rapid repair might be value return or emotional catharsis over reaction. Historical means are merely references, not mandatory return destinations, especially when market underlying logic undergoes qualitative change. Skeptics are right. Silver has indeed experienced countless cry-wolf false dawns. Tightening will ultimately be alleviated by new capacity, substitute materials, or investment fervor, cooling. These historical lessons remind us to beware linear thinking. Markets are always dynamically adaptive. However, adaptation requires time. When signals confuse, participants' instinct is risk aversion. Factories over-order, investors diversify allocations, intermediaries deleverage. These behaviors might long-term smooth volatility, but short-term, they won't cool down. Instead, they add fuel to fire. A vivid example is retail processed products premiums. When silver coin and bar premium rates soar, this shows bottlenecks stuck at manufacturing and distribution stages, not source or shortages. But this creates extremely strong psychological hints for retail. Empty shelves mean markets truly lack goods. This grassroots panic emotion reversely transmits to investment markets, becoming another straw pushing prices. Institutional position data caught reports, though lagging, also reveals mysteries. When major funds trim one direction's exposure while doubling down another, this marks risk model adjustments. Exchanges raising margins typically squeeze speculative bubbles, but if prices remain resilient post-increase, this shows remaining positions are all well-funded. Iron, headed longs. This conversely signals market strength. But we must emphasize resilience doesn't equal inevitable rise. Markets can absorb bullish news, then retraces, consolidate at highs exhausting patience, even violently reverse when assumptions are falsified. For silver, key variables are industrial demand sustainability, recycling volume release speed, and macro environment evolution. Currently, these factors remain in dynamic contest. Daily inventory changes, monthly delivery data, regional spot premium C discounts. Each data point is merely one puzzle piece. Analysts must restrain conclusion, drawing impulses. What we can see, markets are self-testing bottom lines, probing how long this price decoupling new normal can sustain. This test isn't black-white instant eruption, but a prolonged tug-of-war-filled process. Ultimately, sustaining all this is confidence. Confidence in contract fulfillment, price authenticity. When confidence is solid, spreads are money, gifting arbitrage opportunities. When confidence wavers, spreads are systemic risk cracks. In silver markets, this confidence faces unprecedented scrutiny. Participants haven't panic fled, but are adjusting postures. Some rush ahead, some observe, some cling to physical markets, will accommodate these disagreements as much as possible until some critical point breaks. Future paths, whether easing through supply increases or demand destruction through price surges, remain unknown. The only clarity, silver has once again become a mirror, reflecting real-time challenges facing global supply chain resilience, monetary credit systems, and market integration. Facing these deep questions, the most rational attitude is maintaining analytical restraint. Observing participants' real behavior under pressure watching, where capital flows, where metal ships, how delivery terms change, is often more valuable than hearing what they say. It is precisely these silent actions that will, in collisions between new data and old constraints, reshape silver market's future landscape. And before then, the tug-of-war between immediate needs and future expectations will continue unfolding.